Hello everyone, welcome to episode 43. So today's topic is mainly about the crypto crash, but predominantly there are a couple of things that I wanted to talk about. One was the fact that Ethereum, another token called staked Ethereum, stETH, which was getting depegged, and there was an FUD article, there are a lot of FUD articles, fear, uncertainty, and doubt articles being written about the fact that Ethereum is getting depegged and comparing it to the Luna USD death spiral that happened. And also the fact that the Celsius exchange is almost collapsing right now and stopped withdrawal. So we'll be talking about these two, and then how it has led or contributed to the crypto crash, and then the overall effects of inflation versus the crypto crash. So obviously, starting with a disclaimer, I'm not a financial advisor or investment expert. Anything that I say in my video is for learning purposes only. Whatever I have learned, whatever I have understood, I try to provide clarity, and I try to explain it in a more easy to understand language in my videos. And you make your own decisions based on your own research. And there's an important disclaimer that I do, is that never ever send your money to people who call themselves as professional brokers or investment advisors. Pretty much everybody who calls themselves as a professional broker or investment advisor, they are all frauds, they're all scammers. They will target you by email, they will target you by comments. Thousands and thousands of people have lost their money sending their money to these so-called investment advisors or professional brokers. There are no investment schemes where you can send your money to somebody else who you don't know and you can get a return of investment from it. So your money, you invest it, which is what we have been teaching, or I have been teaching in this channel quite regularly. So I don't have a Telegram group or any closed groups, but I'm publicly active on Twitter at the Chennai2London. Not only me, if you're in crypto, if you're in fintech in general, you will get latest information, probably up-to-date information very, very quickly in Twitter, and you can follow a lot of people in Twitter. You can see the people that I follow on Twitter, and you can follow anyone. So anything that I say in Twitter is open and public and can be corrected by the others. So a couple of days back, I posted a thread on Twitter explaining what the issue is and what is going on in detail. So you can also read that thread. I'll give you the link in the description, and also all the articles that I'm going to be talking about, I'll give you the link in the description. So in episode 41, if you had not understood what happened actually in Luna, because a lot of articles were written, but nothing was really very, very clear in terms of what exactly happened. So I had broken it down into a layman's language in terms of what exactly happened with the Luna and the USD fall. Why did Luna fall and why did USD get depegged? I had explained it with examples. And if you have not watched it, if you watch it, then you'll get a better understanding of what happened in Luna, and also the risks that are being faced with regards to the Ethereum scenario and how the comparisons are being made, or why the comparisons are being made. So essentially, just to summarize, USD was an algorithmic stablecoin which was created by Terra Group, and they had no backing of real world assets like USDC or USDT, for example, and it was pretty much backed by the demand for Luna, and which caused a concept called death spiral. So when the USD, which was supposed to be pegged to $1, did not retain its peg and lost its peg, that kind of caused the death spiral. So there is a comparison that is being made to a token called staked Ethereum, stETH, that is traded against Ethereum at a 1:1 ratio. So the pegging dynamics is being compared here, where staked Ethereum is supposed to be trading at 1:1 with Ethereum, but it's not trading at 1:1 right now. And that is the reason behind the FUD attacks, or the articles that are being written by a lot of people, where the death spiral is being compared to Ethereum. And we will break it down in terms of the comparison between those two and explain what exactly is the staked Ethereum to Ethereum pegging, or the why is it being compared in the first place. So a lot of social media influencers who have never understood the Luna collapse had even written stories about the Luna collapse. Even when the Luna was collapsing, these are people who had written saying that it's a great opportunity to buy Luna. And even at that point of time, I had advised, I had even put a note saying that do not buy Luna because it's on a death spiral. So these are the kind of people who are now comparing it to the Luna collapse, because they never understood what happened in Luna, and they don't understand what is happening right now. So again, let's just compare the blockchain, the way in which the blockchains work. For example, there are two primary ways in which blockchains works or provide security to the blockchain. One is proof of work, and another is proof of stake. So in proof of work, essentially, we've talked about this in our channel before. Essentially, a complex computational problem is solved by a powerful computer, and this the first computer that solves it gets a blockchain reward, and that's how the blockchain nodes are being written, or the data is being written to the nodes. And these computers are all acting as nodes, and they are all trying to solve the computational problem first, and this is basically called as a hash rate. And for example, Bitcoin is one of the famous proof of work proof of work based blockchains in the world. And Ethereum was also a proof of work based blockchain. In fact, it is still partially a proof of work based blockchain. So proof of stake is where the validator nodes are all expected to have a minimum number of staked tokens, the native tokens. For example, if it's Ethereum, you need to have Ethereum. If it is Cronos, you need to have CRO, for example. So if you have a minimum number of tokens, then these computers are allowed to act as validator nodes, and they can write to the blockchain, and they act as the validation mechanism. And this proof of stake means that in order for you to have 51% control of the network, it becomes more and more complex than a proof of work blockchain, and that's where the security becomes better and better. And obviously, the electricity consumption, the power consumption for a proof of stake is much lower, as there's no powerful computer, there's no powerful computing that is required to solve any mathematical equations in a proof of stake. So in terms of the proof of stake, technically you can own the tokens, you can stake the tokens into the validator nodes, and you will get a small portion of rewards indirectly, and you can participate in the mining indirectly as well. Whereas in a concept like Bitcoin mining, for example, you need to have a computer, or you need to have a hardware to be able to participate in the mining process. But in a proof of stake, if you have the tokens, if you have the native tokens, you can also participate in the whole blockchain proof of stake, and you can get a small reward out of keeping the process of keeping the blockchain secure. So in episode 23, for example, we had done a demo of when Cronos was being created. We had done a demo of how you can stake your CRO to the Cronos validator nodes, crypto.org validator nodes, in fact, and you can earn up to 12% return of investment on the validator nodes by allocating your token, by delegating your tokens to other validator nodes. You don't even need a computer or anything. Basically, you are using your Cronos, using a CRO on the blockchain, and you're delegating it to other validator nodes, and you're getting a return of investment. That is what staking in a proof of stake would entitle you to. Basically, you're getting a reward out of everybody can get a reward. Any token holder can get a reward, unlike the Bitcoin mining where you need a computer. So in fact, in the last few years, most of the new blockchains that are being created, like the BNB chain, Cronos, for example, they're all going into the proof of stake method instead of the proof of work. And Ethereum also decided in 2020 to migrate from proof of work to proof of stake. In fact, Vitalik Buterin had written a great article in November 2020 about why proof of stake, explaining the differences between proof of work and proof of stake. I'll provide you the link to this article. It's a great article to understand the details behind proof of stake versus proof of work, and also some of the comparisons in terms of the cost and the electricity consumption and everything else. So as such, in December 2020, Ethereum staking went live. So Ethereum staking is already live, and you can, if you go to the Ethereum staking webpage, you can currently see that their ABR is about 4.2%, and about 13.47 million Ethereum is already staked on the Ethereum chain, and the staking is already live. The proof of stake is already live. Part of it is already live in the Ethereum stake. We'll talk about why it is only part of it in a minute. But essentially, there are about 4 options that Ethereum gives you in terms of how you can stake your token. So the first option is obviously solo home staking, which means that you have a computer, you need to have a little bit of technical knowledge, and you need to install the staking code in your computer, and it needs to be connected 24/7 to the internet, and you need to commit a minimum of 32 Ethereum to begin the staking process. These computers are then called as nodes. The second option is staking as a service. When somebody else has already done the first part and they have a node, for example, you can delegate your Ethereum to those node owners for a small fees. And this is very similar to what we did in episode 23, where we put our CRO on the Cronos network on other validator nodes. The only difference is when we did it in Cronos, even if you had 20 Cronos or 30 Cronos, you could have done that. It's 20 or 30 CRO, you could have done that. But in terms of staking as a service, where you can delegate your Ethereum to the other validator nodes, you still need a minimum of 32 Ethereum. So as an alternative, they give another option called pool staking, which is commonly referred to as liquid staking in Ethereum or in most blockchains. What it allows you to do is it allows multiple people to pool together, and they can contribute any small amount of Ethereum, and then these tokens are collected by third-party utilities, and these third-party utilities then would go and do a staking as a service by putting your tokens into a staking pool, collecting once they've collected 32 Ethereum, for example, minimum of 32 Ethereum, for example. So it's basically a pooled staking option where a group of people have come together, like a crowdfunding. And the fourth option is obviously centralized exchanges, where if you put your token, if you keep your token in a centralized exchange, with or without your knowledge, they can go and do a staking into the Ethereum network and get a 4.2% interest out of the process in terms of the rewards that they can get. But again, there is a lot of risk in this process, and it's a bit less reliable. So we'll also talk about this towards the later stage when we talk about Celsius, for example. So staking on the validator nodes, you can probably compare it to like a fixed deposit in a bank. So you're putting it in a bank, and there is currently in most networks there is a 28-day unbonding period, where if you want to take your money out, you need to wait for a minimum of 28 days before you can unstake it. So in home staking or staking as a service, you have directly staked it, and it's your own Ethereum, and you can withdraw it whenever you want. Obviously today the withdrawals are not allowed. We will talk about it. So the beacon chain, that the beacon chain is the name that was given to the chain in Ethereum which allowed the staking in December 2020. But currently, Ethereum is a bit unique right now, where the old chain, the Ethereum 1.0 as it is called, and the beacon chain is running in parallel, and the beacon chain is going to merge with the main chain probably in another 2 or 3 months. It was supposed to be about 18 months after the origin of beacon chain, but it has not yet happened. So which means that you can only stake it into the beacon chain right now. You cannot unstake it from the beacon chain at the moment for all the Ethereum that is staked onto the Ethereum staking. Now, what it means is that if you translate it roughly, the bank has said that you can deposit into your fixed deposit, you will get an interest out of it, but you cannot withdraw your Ethereum, or you cannot withdraw your deposit, or you cannot take out your interest from the bank. That's what they have said. But because people have a lot of trust in this bank, they have deposited their money without even knowing when the withdrawals are going to be allowed. They know for sure at some point of time withdrawals will be allowed. Similarly, the ETA for the merge for Ethereum is another 3 or 4 months, or maybe 3 months. And in October 2022, let's say, for example, only then withdrawals can be started. But people have been staking for almost more than a year, knowing very well that they cannot withdraw it in the shorter time period. So as of today, you saw in the Ethereum main page, about 13.47 million Ethereum is staked in the Ethereum beacon chain. So roughly 2/3 of this is staked using option 1 or 2, where home staking or staking as a service, where people had a minimum of 32 Ethereum and they have directly staked into it, so they can unstake it when the withdrawal process begins. 1/3 of the Ethereum is staked using some sort of pooled staking. So we talked about the third option, which is pool staking or liquid staking. So out of the 13.47 million, nearly about 4.5 million roughly is being staked using some sort of a pool staking option. So 13.47 million Ethereum, which is roughly translates, before this crypto crash happened, Ethereum was trading around $2,000, which means about $27 billion of Ethereum worth of Ethereum has been staked into the Ethereum beacon chain. And today the value is around $1,300 roughly, which is about $17.5 billion, which is still a huge amount of Ethereum that has been staked into it. Now, for the liquid staking, there are a lot of providers. In fact, there are about 6 or 7 providers which no one talk about, because there is a provider called as Lido Finance, which has kind of become synonymous to the liquid staking as a third-party provider, because they control pretty much 99% of the liquid staking market. So as you can see, if you go to Lido Finance website, you can see that about 4.2 million of Ethereum, the pool staking Ethereum, is being staked in Lido Finance. So like we said, about 1/3 of the entire staking is controlled by the pooled staking market, out of which nearly 99% is controlled, I would say, or probably more than 95% is controlled by Lido staking. So Lido staking has kind of become synonymous to the liquid staking concept, even though there are other providers. So we'll only talk about Lido staking for today in this video. So Out of this 4.3 million, you can see that the Ethereum native staking APR was about 4.2%, but on the Lido staking website you would have noticed it's about 4%. And that difference, where they are giving you a slightly lesser APR, is how they are able to get their revenue mechanism and sustain the margin by providing you a more sustainable APR, which is less than what Ethereum native staking is providing. So they will get the 4.2%, take a 10% cut, and they will then give you a 4%. Basically, that's how the model works, and that's a very sustainable model in terms of what Lido Finance have come up with. Obviously, when staking with, this is actually an excerpt from the Lido Finance page. So users, when you stake your Ethereum, how do you know that you staked Ethereum? What do you get in return? What is the identification, right? So basically you get a token called as staked Ethereum, stETH, which is given on a 1:1 basis. So if you put 10 Ethereum, you will get 10 staked Ethereum tokens. And these staked Ethereum balances, you can see it in real time, and you can then use it to do lending, and you can use it like Ethereum. That is the advantage of having this token stETH in the first place. So that is why it is called as liquid staking, where in Ethereum staking, in normal Ethereum, if you stake it, then you lose control of your token, right? You don't have it till you are able to withdraw it. Till that point, you can't do anything with it. Here, the representation token that they're given you, staked Ethereum, to say that you have staked Ethereum, you can actually go sell it to somebody, or you can go and trade it, you can do collateralization, you can do everything, denoting the fact that you have Ethereum in it. We'll use a real world example, and you will probably better understand it at that point. Also, there are no lockups, or there are no minimum deposit from a Lido perspective, right? You can even put like 0.1 Ethereum, and you will get 0.1 staked Ethereum token, for example. So you can also see, for example, if you staked it, every day you can see how much APR rewards you are getting for participating in the Ethereum. You can see your APR percentage, you can see your rewards. Now, how does that work? So again, I'm borrowing the diagram from Lido's website. So as I said, Ethereum 1.0 is running, and Beacon chain is running in parallel to the Ethereum 1.0. So you will stake your Ethereum, and you will get your staked Ethereum token on the Ethereum 1.0 chain. So when Lido is giving you the staked Ethereum token, they are giving it to you in the Ethereum 1.0 chain. Then Lido will then take all of the Ethereum that has been collected, and they will then put it into the Beacon chain, and they will stake it in the validator nodes on the Beacon chain. So that is how they are maintaining the relationship right now. So when the merge happens, this will obviously be in the same chain. And again, the reverse of it is that every day or every few hours, the Beacon chain data is then collected by the oracles, which then tells the Ethereum 1.0 chain inside Lido staking contract, saying that how much APR percentage or how much tokens have we gained by the staking, because that is not still available for withdrawal yet. But the data is available to be collected using an oracle, that is then collected. And that is how in the Lido Finance website, if you go, you can see how much staking rewards you're going to get for these Ethereum that you have staked into Lido Finance. And again, they are showing you how they're taking 10% as a reward, and that's how they are maintaining, or that's how they're running the operations basically. So for example, if you go and deposit 1 Ethereum in the Lido Finance and you get 1 staked Ethereum, you should roughly get 1.04 Ethereum after 1 year at a 4% APR. So this will translate to 0.0001 Ethereum per day, or 0.9 per day. And what will happen is, on day 1, you will deposit, you will get 1 staked Ethereum as your balance. And day 2, you will see that your staked Ethereum is now going up to 1.0001 staked Ethereum. Day 3, it will be like 1.002. And then at the 10th day, for example, you will get 1.001 staked Ethereum, for example. So that is how you will see the real-time reflection of it. Obviously, there's a little bit of slashing that could happen, but I've taken a really simple example to give you an understanding of how this process works. Now, there is one risk, obviously, with Lido Finance, which they have stated very clearly, that staking during the first stages of Ethereum 2.0 means that your Ethereum will be frozen, and you cannot unstake it, you cannot withdraw it till the Ethereum merging happens. Till that point of time, you can, however, sell your staked Ethereum on another exchange if you want to. This is very clearly mentioned. And one of the biggest attractions of liquid staking is obviously, like I said, that you can trade your liquid staking token to another token, or as the token that it represents. So for example, this is not new to Ethereum. This is there in many other platforms. In fact, even in Kronos recently, Argos protocol had launched, where you can stake your CRO instead of staking it natively into the Kronos chain or the crypto.org chain. You can stake it into Argo protocol, where you will earn the same 12% interest, but they will give you a token called BCRO as a representation of the token that you have staked into the Argo protocol. And what you can do is you can go sell your BCRO if you don't want it, if you really need it, if you really need liquidity or money, you can go and sell your BCRO without waiting for the 28-day unbonding to happen. And that is where the liquid staking concept comes into benefit, in fact, for people who want to do it. So the same way, the convenience is that the staked Ethereum tokens can be traded and also used as a collateral, very similar to how you can use Ethereum. And so technically what it means is that it represents one Ethereum. So in essence, one staked Ethereum is pegged to one Ethereum. So unlike the UST where it is pegged, where it needs to be pegged to $1, here it's just a token representation. It's just a convenience factor that in a trading in a secondary market, that if you are going to trade one staked Ethereum, whether or not you're going to get one Ethereum is based on convenience, and it's based on the market condition. It is not based on a pegging algorithm, or is it not based on a pegging condition that it always needs to have one Ethereum behind it. If you go and unstake it in Lido Finance, you will definitely get one Ethereum back when the beacon chain merging has happened. But till that point, the trading exchange ratio where one staked Ethereum needs to be one Ethereum is just a convenience. And we can see that better, we can understand that better if we talk about an example, a real world example for example. So let's take gold as an example, right? So if you deposit gold into a bank in a 1-year deposit, for example, and let's say they give you a token, a gold token as a representation. It's not real gold, but they give you a token to say that this token represents 1 gram of gold. So if the 1 gram of gold's value is 1,000 rupees, this token you can go and sell it to people saying that I have this gold in the bank, this token represents it. Can you take this and give me 1,000 rupees? And people might give you 1,000 rupees because people trust the bank. People know that they can go and redeem the token for the real gold after a year. And that means that they know that this token actually represents gold, which is in a safe locker in a bank. So this gold token pretty much has the same value as the gold itself at this point. But if you go to a pawnbroker and if you're saying that, okay, here's a token, give me 1,000 rupees. What the pawnbroker is going to do is that he knows that you need money. He knows that you are desperate for money. He knows that you want liquidity, and he knows that you have to wait for 1 year to actually get the real gold. So he will make use of the opportunity and your position, and he'll say that I can give you only 990 rupees or maybe even 900 rupees for all you know, right? This is an arbitrage scenario. The pawnbroker is going to benefit from the fact that he knows that you are in need of liquidity, and even though he knows that he can get the gold which is worth 1,000 rupees because you need it 2 months earlier, 3 months earlier, 4 months earlier. This happens with chit funds, where you know that the money is going to mature in about 4 or 5 months, but you can have the option of breaking the maturity and say that, okay, I'll take a 5% penalty and I will take only 95% of the money. So this happens in chit funds and in so many recurrent deposits. Some of the banks allow you to do it. So the same thing pawnbroker can also do and say that, okay, I'll give you only 900 rupees or 950 rupees, for example. So this is exactly what is happening today, where the staked Ethereum, when you're going and selling it to Ethereum, it can either be lower or higher to the Ethereum's value, depending upon the availability of liquidity and what the people are willing to buy the staked Ethereum from you, till the point the beacon chain and the withdrawals are not active. When the withdrawals on the beacon chain are active, if you are getting less than 1 Ethereum from a secondary market, you always know that you can go and withdraw it and you can get 1 Ethereum directly from the withdrawal itself. So till that point of time, this is basically a secondary market that is controlled by availability and supply. And that is what is happening, which is where the huge difference between Luna and UST to Ethereum and staked Ethereum is coming into picture. So there's always a possibility that staked Ethereum will not trade at 1 Ethereum. In fact, from the beginning, the liquidity was created only for this arbitrage scenario, or in fact, the liquidity was created for convenience. So you can trade, you could technically trade one staked Ethereum for more than 1 Ethereum, for example, 1.01, 1.02, and it has happened in the past because they know that this is a staked Ethereum, which is an yield-bearing token or an interest-generating token. People have bought it for more than the value of 1 Ethereum at some point of time. And today, obviously, it is less than the value of 1 Ethereum. So you could buy it for more or less depending upon the market conditions. And it is not comparable to the depegging that happened where USD was supposed to be pegged to $1. It was not a convenience. It was supposed to be an algorithmic pegging to $1. That's where the huge difference coming into picture. So the fact is that right now today, one staked Ethereum, when I was making this video, one staked Ethereum was trading for about 0.93, which is technically like a 7% discount on Ethereum that you're going to for sure get when you redeem it at the point when Beacon Chain is going to become active. Now, obviously the desperation means that a lot of people want liquidity and they are in need of urgent liquidity, so they're selling it, and they are selling it for a discount knowing it, and people who are buying it knowing that they are buying it for a discount. So this is nothing new. In fact, this is not something that is happening today. A lot of people claim as if this is happening only right now after the Luna's depegging and comparing it, but it's not new at all. In fact, if you actually check the lifetime comparison between the price of staked Ethereum to Ethereum, it has never maintained its 1:1 liquidity last year. Almost the entire last year, it was going up and down. In fact, for a long period of time, it was below peg to Ethereum. One staked Ethereum was getting about 0.92 Ethereum, even during last year, mid of last year, like May to 2021, for example. A lot of time it has gone below 0.95, 0.96, 0.97 and all that. So it has hardly maintained the peg. The only reason we are talking about it is in the last 6 months, it has been maintaining a peg where people have been looking forward to this Beacon Chain becoming live, and people were saying that, okay, it's going to happen soon. The liquidity was getting better and better. So you could have gone and got 1 Ethereum out of one staked Ethereum. So that is what is happening. But obviously, because of the market crash, the crypto crash, the inflation, we'll talk about it in a minute, which means that people need the liquidity, people need money, and they are more desperate, and that desperation is being used, which is where the depegging is happening. This has nothing to do with the Luna USD comparison, which a lot of social media influencers have been calling out incorrectly and quoting, and in fact, this is creating FUD on the minds of investors, fear, uncertainty, and doubt. And sometimes I even wonder if this is being done intentionally, because these people have written brilliant articles before, and it is hard to fathom the fact that they are writing a comparison between Ethereum staked Ethereum to Luna USD incident. So this is an FUD that I wanted to explain. I had explained it in my Twitter thread, but I also wanted to explain it in a video. So is there a risk? For example, there is definitely a risk. There are some people who have rightly explained. I will give you the links for those people as well. They have rightly explained the risk behind. Why exactly is it worrying the fact that staked Ethereum and Ethereum is not maintaining its exchange rate? That is definitely valid. Now, what's the worry, or what's the issue in that scenario is the liquidation scenario. So there are a lot of people who've done a circular collateralization. This is almost like leverage trading, I would say, for example. So there are a lot of places where you can borrow Ethereum against your staked Ethereum, like Aave and Curve Finance. How does it work? So imagine if we start with the concept, we start with the position where one staked Ethereum is equal to 1 Ethereum. So you have 10 Ethereum to begin with. You go to Lido Finance, you stake it, you get 10 staked Ethereum tokens. Now you go to Aave, for example, and you then put 10 staked Ethereum token as a collateral, and you will get a 80%, it is 81%, and for convenience I'm maintaining it at 80%. You can get 8 Ethereum as a loan from Aave. So you can then, this is your position 1, for example. So you now have 8 Ethereum. Now you can go and then stake this 8 Ethereum in Lido Finance, get 8 staked Ethereum. Again, you can collateralize it in Aave, and you can get 6.4, 80% of it. And you can do the same thing again, you can get 5.12. So you can keep doing this till you can get a healthy position out of it. Now, imagine if the market is going to go up, you can obviously sell your Ethereum and you can keep doing it, and you can go back to your the top pool and top position, and you will probably have made a 1 or 2 Ethereum profit out of it if the market keeps going up, for example. Now imagine if the one staked Ethereum is only 0.9 Ethereum, if it has come down like it is happening today, right? 0.93. Let's take a point where it's come down to 0.9 Ethereum. That means you have to maintain this collateral ratio. So if you are maintaining only 80% ratio, then you need to buy and supply more staked Ethereum as collateral to maintain the 80% ratio. This is almost like a derivative trading. If you don't do this, if you don't maintain your 80% ratio, your assets will get liquidated. Now let's look at it with example, with the value, right? So what happens is, this is the example that we talked about. So 80% is what we are talking about. If staked Ethereum is not 1 and is 0.9, that means that the staked Ethereum that is needed for maintaining position 1 is 11.11, for position 2 is 8.89, 7.11. That means you need an additional of 2.7 Ethereum to maintain the 80% collateral ratio at that 0.9 basically. So you need about $3,500 in today's value to maintain all these 3 positions from getting liquidated. Otherwise, you are going to lose your entire value of tokens. You're going to lose all the Ethereum that you have supplied, all the staked Ethereum that you have supplied. You're going to get liquidated here. That is why it is such a risky strategy. And also, you do not get the opportunity. There is no warning or anything that's going to happen. If it goes below the 80%, if it goes below the liquidation collateral, even 1%, it will get liquidated. So you're not going to get an early warning or anything like that. As soon as the exchange rate fluctuates, as soon as the Oracle detects that the collateral ratio is no longer 80%, it is going to liquidate your position, which means technically the collateral that you need to maintain is going to be much higher. So you need to keep adding collateral after collateral so that you are not getting liquidated. And if the market falls so drastically like it has fallen in the last few days, then you are at much more risk of getting liquidated. That is what is happening. A lot of these people who had taken up such positions, they were literally gambling. I mean, obviously leverage trading is completely gambling. They had been completely liquidated, I would say. A lot of people have been liquidated. Aave had even posted a note on their website or a explanation about, there is an interesting graph as well as to how much percentage of depegging will cost, how much percentage of liquidation. So they are estimating a 15% depeg, 0.85 if it goes to 1 staked Ethereum goes to 0.85 Ethereum. They're expecting about $250 million liquidation if more collateral is not added to the collateral positions or the liquidation positions right now. So I will give you a link to it. You can go and read it in detail as well. So now comes to the Celsius angle to the story. So I mentioned in episode 41 where why I keep talking about only a handful of crypto tokens, handful of blockchains, decentralized exchanges, and also centralized exchanges, and I provide links to those decentralized exchanges or centralized exchanges in my videos, saying that these are the ones that I trust, these are the only ones that I will keep my funds in. And the reason I do this is because, which is where I mentioned that I never use Luna or I never use UST as a stable coin. And the reason why I do it is because, when you are keeping your money in centralized exchanges, they are basically custodial wallets, which means the centralized exchanges can actually fully control our crypto and they can play with our crypto. So it is very important to know where to keep your money. So it's like, if a bank is going to take your money and they're going to play with it, then you really don't want to keep your money in that kind of bank, right? So which is why I have not mentioned a lot of crypto exchanges, for example, Celsius and Nexo, CoinSwitch, Kuber. I have never mentioned any of these kind of exchanges, centralized exchanges, because it's not something that I would recommend to anyone, or it's not something that I would personally use. In fact, forget about recommending. So I have only talked about those centralized exchanges which I personally use in all of the 42 videos that I've made. So one thing that central exchanges do is that they provide you very, very attractive rates, which is what Celsius did. They provided such an attractive rate that was extremely attractive, but it's also extremely dangerous and risky in my opinion, which is one of the reasons why I've been avoiding Celsius. Knowing very well they cannot afford to give you this kind of an exchange rate unless and until they have taken an extreme risk with it. So very few centralized exchanges have got a transparency in terms of showing you what is the real balance that they're maintaining in their cold wallets and hot wallets. For example, Bitrue offers you a near time or real time view of what is their collateral in terms of hot wallet and cold wallet to maintain the customer funds. If a customer is depositing 100 bitcoins, they're providing a collateral equivalent of how much they are maintaining, which means that if everybody wants to withdraw, they're always showing you like a glass box, how much money they are holding in that bank basically. So and they do this by operating in a much more safer way. So for example, they do offer DeFi interest rate, 60%, for example. They were offering it on Cake. But the reason they were able to offer it is because PancakeSwap was offering 80%. So they can take the customer funds and put it into PancakeSwap, get 80%, and they can offer 60% to the customers and keep the 20% revenue, which is sustainable for them and is also easier for the customer, knowing very well it's being staked in a more safer environment in DeFi directly. And if they know how to connect to a MetaMask, if you watched my video, if you learned it, how to connect to DeFi, how to do it directly, if you take that extra effort, you can obviously get the direct 80%. But if you don't want to, for those customers who do not want to put in that additional effort, they get the 60%. So which means that they're maintaining a safer option in terms of staking and providing you with a benefit. But however, Celsius and some of the other websites, they were offering interest rates that were more and more dangerously higher than what you could earn directly in DeFi yourself. So how they were able to offer these kind of exchanges? Obviously, the reason why they did it was to attract customers. So potentially, they could have leveraged those assets, is what the allegation is. And for the last 10 days or so, there were a lot of tweets that were going on saying that there is a liquidity crisis that is booming in Celsius network, and a lot of depositors who have loaned their coins, not even deposited their coins, people were using the term that they've loaned their coins to Celsius, because keeping it in Celsius, which is a centralized exchange that is using your tokens and earning money for themselves and then providing a small portion of it, was termed as a loan. It's like a mutual fund where you're putting money into a fund and they are playing with it by buying whatever they want. So for example, if a mutual fund has taken your money and bought LIC tokens, LIC IPO for example, they are going to be at a loss right now. It's about 40% down right now. Again, it's not a right example because it's supposed to have been a safer option, but here they have taken the money and they have probably done a collateralization or a circular collateralization with that, which is what has been the allegation for the last few days, comparing it with this staked Ethereum scenario and what Celsius could have done. Again, a lot of it is speculation, but a lot of on-chain analysis based on what historically Celsius has been holding suggests that Celsius has lost about 120 millions in a couple of DAO hacks, and they have also lost a lot of money potentially in the Luna USD debt spiral, which they have not clarified in terms of what their full impact has been, or they have not clarified what their impact has been. They have just maintained a defensive stance in terms of the Luna USD debt spiral. And also, potentially, the on-chain analysis also shows that 73% of their Ethereum reserves are locked up in collateralized, either locked up or collateralized into Ethereum staking on the Beacon chain, which is not redeemable yet. So the percentage breakup of the 73% is not known, like how much percentage is with Lido, or how much percentage is directly staked onto the home staking option, for example. So again, if the customer had agreed that it is going to be locked up for an indefinite period or 3 or 4 months or whatever it is, then it's another story. But if the customer never understood the fact that he was locking up his token, or if it was going to be used by Celsius to be locked up in the Beacon chain or in Lido or whatever it is, then that is where the trouble comes in, because it has never been clear how the Celsius APR interest has been generated. So the fact that Celsius actually calls themselves not as a crypto platform, they call themselves as a wealth management company. So that itself is an alarm to start with. A couple of days back, there was a Twitter chain that was going and saying that there was an AMA that was supposed to happen, and the CEO of Celsius, Alex Mashinsky, suddenly there was an announcement saying that he lost his voice and he's not able to attend it. So where people were expecting him to come out and talk about it, saying that everything is fine, this is all FUD, and they were expecting him to come out and talk openly about it. This felt eerily closer to the USD Luna scenario, for example. But after denying the liquidity issues, even on 12th of June, for example, afternoon, he denied the allegations, he denied the liquidity issues. He says that there is nobody in Celsius who's having a problem withdrawing from Celsius. Show me one person who's having a problem withdrawing from Celsius. Hours later, a few hours later, after he had even come out and said that, Celsius made a public announcement saying that they are pausing all the withdrawals, all the swaps, all the transfers, meaning all your assets are completely frozen in Celsius. Obviously, this could be temporary, but it's just categorically different to what Alex was saying a few hours back before this announcement came, and that is where all the allegations that were being made, people start to understand it better and better in terms of the liquidity issues that Celsius is facing. Now, one of the terms and conditions that Celsius has, somebody had posted it, I'm borrowing that here, is that if you had used your tokens for the earning service, meaning you put it to say that I need to earn interest on it, then it is not going to be recoverable, or you will not have a legal right to have a recovery of it in case Celsius becomes bankrupt or enters into liquidation. This is completely different to many other custodial wallets, where they say that if you are keeping your assets under our custody in terms of Bitrue or other exchanges, for example, then they have an obligation to give you your digital tokens back, is what most of the terms and conditions would state. Celsius has got a terms and condition that says that they are under no obligation to under applicable laws to provide you, in case they become bankrupt, to return back your money. This is like a bank saying that you give us your money. If you become bankrupt, we will not give you back your money. So that is kind of what Celsius is saying. Now, obviously, these stories are very, very relevant in terms of why the crypto market is crashing, because panic is setting in, FUD is setting in. People are expecting that Ethereum will fall similar to the Luna, without having any understanding between the difference between the two technical aspects of pegging, and why it needs to be pegged, or why it was pegged in the first place. And again, this has also started exposing the vulnerabilities of Celsius and the liquidity issues of Celsius. Now, the reason why it is more and more important is because apparently, as per estimation this week, obviously the crypto value keeps going up and down. Celsius holds nearly $12 billion of crypto assets, and 1.7 million customers have their funds in the Celsius exchange. So they're all now completely locked out of their crypto assets. They can't sell, they can't use it, they can't do anything with it, they can't trade with it. Even if they had USDC or USDT, is completely locked out. And there are similar centralized exchanges like TradeFi, BlockFi, Nexo. There are so many ones. In fact, Nexo is interesting because Nexo is offered to buy some of the assets of Celsius in case they go into liquidity issues. They've made a public offer, for example. But in my opinion, they're all operating under similar tones, and I wouldn't keep my money in any of those centralized exchanges, for example. And in a bad economy, everything that has happened in Luna and USD, people are in a panic mindset, and this is having a continuing domino effect in terms of the crypto downfall. So again, this is also related to inflation. The whole crypto crash is also related to inflation, but this is all kind of interconnected, because inflation is rising at an alarmingly high rate in many countries, and compared to the earning potential, that is where the key difference is. Inflation is nothing new in India. For example, the commodity prices, many of the commodity prices have increased by 5 or 6 times in the last 10 years in India. For example, rice and essential lentils and everything has gone up by almost 3 or 4 times in the last 10 years. So this is not new to a country like India, for example. So, but we have to compare it with the earning potential. The salaries of people in India about 10-15 years back as compared to today has also gone up significantly, or comparatively. It is not, I would not say that it was going hand in hand, but it has gone up comparatively. If you compare it to countries like UK, for example, the average salary increase per year is less than 1%. People who have been getting maybe £2,000 per month 10 years back, they will be getting about £2,050. There hardly been £50 monthly increase in terms of the salary in the last 10 years. And that is where the inflation and what the impending recession is having an impact in terms of the commodity prices. For example, in the last 10 years, 12 years, for example, you could buy 2 liters of milk for £1. In many places, you can go and buy for £1. Even when it was going up to like 1.1, 1.2 pounds, people were obviously selling it as 2 for 2 pounds. You could still say that, argue that you can buy it for 1 pound. And the price of petrol was, now the price of milk is about 1.5 pounds. It's gone up to 1.6, 1.7 in many places. So about 50% has gone up, where the salaries have gone up by literally 1 or 2% in total. And the price of petrol was about 1.1 pound in 2020, about 110 rupees, let's say. It's touching nearly 1.9 pounds, 190 rupees. In about 2 years, it has gone up by almost 80%. And what it has all meant is that the disposable income people are having or used to have has now shrunk, and leaving them with no money for investments, let alone investments. They don't have enough money for making their ends meet. For example, the monthly electricity and gas bills are now almost 3 times higher. People where they were spending like 100 pounds per month on gas and electricity now are spending like 300 pounds per month. And if you're getting only 2,000 pounds per month in terms of rent, then your disposable income was only about 100, 200 pounds after all your bills and rent and food and everything put together. Now, if your gas and electricity bill itself has gone up by more than 200 pounds per month, that itself is eating up into your disposable income. Now, you don't even have enough money to pay for your food or pay for your other aspects of life, which means that to support their real world life, to support their needs in real world, to support their finances, people are liquidating their positions. They are selling their shares, they're selling their crypto, they're selling all their investments in order for them to sustain this point where the economy is in such a bad position. So, which means that people, if they have invested their essential funds, they're getting out at a loss because they have to get out. They don't have money to survive in the market. Even people who have invested money thinking that they don't need it right now, because of the shortfall in terms of the earning potential to the expenses, they are now having to exit their positions, which is being utilized by the market. Again, it's a supply and demand scenario. When people know that people are desperate, they are ready to sell it again and again. People who are buying it at a lower and lower prices. So the rich are getting richer and the poor are getting poorer. Is a scenario that is kind of happening even now, where it was kind of different in crypto a few months or a few years back, let's say. So all of this kind of started with the Ukraine war, with the Luna USD crash, and it's kind of, it's like a negative news that is getting snowballed, and it is having a direct impact on the retail users' confidence. So when a new retail user who even has money is trying to come in, he's looking at what is happening to others around the market who are exiting with negative positions. This is all the reason that is contributing to. It's not necessarily a reflection of the crypto market or what has happened in crypto itself. It's basically the impact of the real world is being felt in the investment world as well. So I've said it in my previous episode, and I'll kind of reiterate. Crypto obviously is a very, very volatile investment. So if you started in 2022 or if you started in late 2021, then it's probably one of the worst entry points in terms of when to start in crypto, because you're practically seeing the complete downfall of crypto because of all the other factors that have been happening. So at the moment, there is not much that we can do as an investor, and there is no way to confirm what the bottom is. And I do not believe in all these charts which say, compared to 2020, compared to 2018, 2015. It's not, in my opinion, again, it's a personal opinion, there is no way to confirm, because these are all FUD attacks, these wars and everything that is not, it's not predictable. If this had not happened, then we wouldn't have seen. This is kind of a butterfly effect that we are seeing. It is not a prediction of a mathematical or statistical model that we are seeing right now. So again, the positives catch on, the negatives are also catching on. It's like snowballing with each other. So personally, all that I can say is that I'm practicing patience. If you had followed me from 2020, I had talked about, right from my first videos, I talked about holding a position of XRP at a loss for nearly 3 years. And even when I was making my initial videos, I was telling that I'm not going to sell it. I'm going to maintain it at a paper loss. I will sell it only when I am able to make a profit. At a point where it was at a loss for me, and I was holding it for 3 years. That is how openly I was explaining about my position in XRP. And it did happen where XRP went up so high at a point where I was able to sell it at a good profit after waiting for 3 years, nearly more than 200-300% in terms of profit. And if you had watched my initial videos, you will know this, because I've been talking about it during the time, September 2020 onwards, I've been talking about this position. So what you can do is you can take time, if you have invested in crypto, invest your time now and learn a lot about the crypto market. Learn a lot about the concepts that I was talking about in this video. For example, I'll provide you all the links, all the Twitter links, and it's a great source of information, and knowledge is the key to survival here. Knowledge is the key to everything. So, you know, before you invest your money, make sure that you're investing enough time into it and understand what you're doing. Again, hope you found this useful. Until next time, thank you. Bye.